So, boiler mechanic economics slash politics slash accounting, mechanics accounting today. I never thought in my life I would be interested in accounting at all. So, it is a beautiful Sunday here in Florida. Uh, Getting kind of warm, but not, uh, hot yet, in my opinion. I've lived here long enough to where that's not going to be a big deal to me. What we have right now, about 80 something degrees, maybe getting 90 at midday, but it's dry heat. So I wanted to talk about this SVB thing. And, I've waited to make a video about it. I have posted a little bit about it here and there. So this is such a very interesting story. Now, a lot of people are dooming, and I refuse to go straight down the doomer road from the beginning because, the premise of this bank is that it's Silicone Valley Bank. And they are primarily a firm for venture capitalists in Silicone Valley. An interesting bunch of people that must be. And so, from the beginning, the first, steel man argument that came to my mind from from a perspective of the banks, this being a systemic issue, was that this is a bank that is primarily in the space of the tech industry, which itself is having some bad times right now. Because the bottom line with that is they jumped on the bandwagon of quantitative easing and all that, especially after during the COVID episode, and they did that because they benefited the most from it. And it's human nature to just push the limits of all things. So if you're making a lot of money in Silicon Valley, or if you're in that space, there's going to be a tendency for entrepreneurs, bankers, and everybody else involved to push the limit. They're already on the quantitative easing bandwagon, which itself is a scam. So why wouldn't they scam some more? I mean, just looking at it from a purely bozo perspective like myself, why wouldn't they scam some more? And that's what happened with Silicon Valley Bank from what I see. Now, I've watched 4 or 5 different videos from all my favorite people, and some have a more balanced approach, but nobody is, and some were doomers straight from the beginning. And what the ulterior motives of that perspective might be, I can think of a few. If you're Peter Thiel or Mark Cuban and you're heavily invested in this space, and you have money and deposits like Mark Cuban and Peter Thiel at in this bank, which is the primary bank for people in this space, people whose job it is to make money out of nothing, essentially. I mean, that's what the tech industry became in a lot of ways. I don't see a lot of their products, just to get on a purely more like Marxian perspective here. I don't see a lot of their products actually producing anything of value. If we look at it from a net perspective, has Facebook added value? To some extent, there's Facebook Marketplace, but and there's the content creation space, which I would say is value. Entertainment is always value, if it's good entertainment. But yeah, these people are, in other words, they're fucking scam artists. A lot of them, from my perspective. And no, I'm not a socialist. I'm more of an anarchist. But I like to bring up Marx just to please the Marxists, to let them know that I'm not totally, I'm not one of these libertarians that is hysterical about socialism. But that's another video for another day. I'm an anarchist, pure, plain and simple. Let people be socialists if they want to. Uh, Socialism and capitalism have always existed. They're two sides of the basic nature of the human animal. Well, I'll put that for another video. So these are scam artists, so it doesn't surprise me. Now, it doesn't surprise me that they were engaged in questionable practices, especially at this bank. So Alfonso, he is an Italian man, probably a little younger than me. I was going to say young man, but he's probably about 10 years younger than me. He's probably in his 30s. He knows the banking industry. He knows accounting. He's a very good commentator. Very, very reasonable. And he goes through a thread here where he essentially gives you a rundown of the accounting and some of the intricacies and nuances of this situation. And basically about what his argument is he's looking at how they were trying to hide their unrealized losses through an accounting trick, that they didn't hedge their interest rate risk. So look into interest rate swaps and all that. Go to Investopedia right here. This is their news really sucks. It's like their news really sucks. Just look through their news. It's like some WEF nonsense, right? But it's just like you can put in interest rate swaps, and then you get all these. Look, you got the interest rate swap definition, and their articles are very well done. Hyperlinked just like Wikipedia. Whoever, I don't think this is a user content, right? But whoever does the articles or oversees the articles does a good job at actually creating a very valuable resource for idiots like me who came into this maybe 2, 3, 4 years ago not knowing anything about finance. And I can tell you now, after a lot of obsession and a lot of hard work and getting my feet wet in the market a little bit, I can now tell you what an interest rate swap is. So if I can do it, anybody can do it. But they needed this bank is just below the threshold of certain regulatory requirements that keep this thing from happening. And I hate regulation. And trust me, I don't want to promote more regulation, but they took advantage of not a loophole, but just a cap in the or a minimum that they had to have in their bank. I think it's total. I don't know. I think it's maybe their deposits, but they were below that threshold. And at that point afterwards, what Alf is saying, and I haven't heard any counter arguments to this yet, is that they didn't have to. They can get away with not hedging the 0% bonds that they bought when the Fed kept the interest rates so low and brought them back to low interest rates after COVID. So ultimately, this is an issue with government regulation. If the government let the value of money be priced by the market, okay, the time value of money, then if we had market determined interest rates all along, this probably would never have happened. This is a consequence of our government, which the Fed is a part of, whether people want to say that nonsense about them being independent or not. Really, they're a merger between the corporate banking sector and the state, i.e. fascism. But that's another conversation for another day. But had they not done what they did with quantitative easing, keeping interest rates at near zero, causing the value of money over time to become basically worthless, this couldn't have happened. At least not like this. Because they were sitting on a bunch of 0% treasuries and mortgage-backed securities that they didn't have a hedge for. So when interest rates rose, as they did, and you can blame the Fed for that too, but they wouldn't have had to raise the interest rates like that. It wouldn't be causing a problem if the Fed hadn't screwed with the time value of money in the first place, which is basically playing God. And we know what happens, going to a little history snippet, we know what happens when people play God in history. We know what happens. It's never good. And this is the government, these statists, fucking with a basic economic component, the value of money over time, the implications of which cannot be foreseen and are always broad and deep within an economy. And we have this situation where the Fed created the conditions for the bank to do this. So I'm not defending government here. It's a very nuanced, complicated issue. But now, so there was a problem to begin with. This company should have hedged, and Alf argues that if they were above the $250 billion threshold, then that would have been, let me see what's going on. Hold on a second here. Okay, making sure I'm recording. So if they were above that threshold, they would have been stress test by the authorities, and that allegedly might have stopped this from happening. The verdict is still out on that, because I know that no regulation is ever waterproof, and there must be ways through those regulations. There must be a way, if it's in their benefit, where they can circumvent regulations regarding stress testing and make that work out in their favor or to their benefit. So there's always that. But they used accounting tricks. Right here, he shows the accounting tricks they're using. They're calling their securities hold to maturity instead of available for sale. I'm not sure. There's nowhere where he says bigger banks can't do this, but they're using an accounting trick, because if it's hold to maturity, they don't have to count if the bonds become less valuable, they don't have to count that as an unrealized loss, apparently. And I'm not sure if he says here, I don't think he does, that larger banks are supposed to do that and have to do that. But anyway, so the Doomers at the end of the day went a little overboard. I always have a tendency to slide into doomerism, so I had to take a breather on this one and figure out how this can affect things. And the way I see it, it's going to be used, as always is the case, this crisis, by opportunists, to call for more regulation that isn't, and none of which would be constructive. All of it would be beneficial to the people lobbying for it. So expect, calls for regulations to be coming from the larger banks, I would expect. That would make the smaller banks less competitive. You're going to see, I don't know if this is really going to take off. It's hard to predict when a hysteria starts or stops, or what's going to cause a hysteria. It's difficult to predict sometimes. Something like COVID, I knew right away that was going to become a hysteria. Whether this becomes a hysteria or not is another matter. And then on their video, Alf and his friend were talking about how there might be a fair amount of fear in the regional bank space, and that might cause some sort of hysteria. And it's also the case that maybe some of these regional banks are also underwater, either because of mortgage-backed securities or treasuries. Whatever they have to hold on their books to counterbalance the deposits, whatever they have to hold to have some form of reserves. So that's possible, because he says they're not under the same regulations as the larger banks. They don't get stress tested. My feeling on that is simply that just look at who was involved in Silicone Valley Bank. These are, by and large, scam artists. If to just put it I don't care about being harsh to them. It's a harsh thing to say, but this is mostly scam artists. Uh, so it's no wonder that, and it's in a place in a space and an actual place for the most part, Silicon Valley, which is full of all sorts of scheming nonsense, And like I said in the beginning, they don't actually. These are people that make money out of nothing. They don't. Most of these products they create to me are seem pretty useless, and it's just a way to create money out of nothing. And they loved the environment of. That's why I mean, it was universally accepted that this was good for tech. Having 0% interest rates, quantitative easing, because they didn't have to buy any as much capital to get a product going. So these companies can generate a large amount of cash with maybe a footprint of a small office. So my take on it is I think Silicon Valley Bank is going to represent the worst, or close to it. There may be something worse than that, but I'd say close to the worst of what's out there as far as these specific issues with interest rate risk. Now, a lot of banks, there's that chart going around, which I will pull up, and this was on Zero Hedge somewhere, and this chart shows unrealized losses in, I guess, the four major banks, and it looks really scary. But what Alf points out, and which I believe him on because he's probably already looked at the balance sheets, those losses are mostly hedged. In other words, they got not credit swaps, but interest rate swap contracts, and they managed to hedge these out. And he can tell that by what he points out to. I was watching Jimmy Dore earlier. Sorry you had to see Debbie Wasserman Schultz's ugly face for an instant there. So, let me see. He goes in there and he shows how he rationalizes whether. Let me pause it. Is it recording? Okay, so he goes into how if you have the same durations on your fixed income assets that you have, your investments, then you probably don't have many interest rate swaps, because in order to get those hedges, you'd have to buy a contract, with a person who's writing that contract. And, I think the tendency is, it makes sense to me that the tendency is that the writer wants to do a different duration. He doesn't want to bet straight against, the asset being insured, the original, bond that the bank is holding. He wants to try and get he wants to try and bet down the duration curve. And then he's gonna, be that to him. It's a game of probability. The guy betting against the bank in the interest rate swap, he wants the highest probability of his investment working out as well. So he's going to go probably along a different part of the duration. Okay, so that's my look at it. But anyway, so. You're going to see, so back to what, I think is going to happen is you're going to see calls for regulations. There's already calls for bailouts, and which Alf points out would be, and I would automatically say is a horrible idea, because this bank was cooking their books, if that's the right term. They were engaging in very risky behavior, putting their depositors at risk. But I'm sure a lot of their depositors were just as corrupt as they were, and they knew what was going on. But they wanted the highest return on their, the highest return they can get out of the deposit. So I'm sure there was enough corruption to go around here, and I think this might be, I dare say it, a kind of a special sort of situation, because this is Silicon Valley. They've always been corrupt. Half of them work for the CIA. Everybody knew that they were going to have problems when the Fed raised interest rates. They knew it as well. They didn't care, and maybe they're politically powerful people within this group, and I wouldn't, and so bailing them out would be just like in 2008 a big mistake. Although, like I said, in 2008 we did it anyway. And now that kind of brings us to where we are now. They don't call it moral hazard. Means that if you do something that encourages bad behavior, expect that bad behavior to continue. Okay, so that's all it means, and that's what we did in 2008, and I wouldn't be surprised if they did it here right now. These are big depositors with some influence. Some of them have an outsized amount of influence. Mark Cuban, okay, would be one. And so that's my take on it. As far as other banks having this problem, maybe some small regional banks, which I'm sure the central bankers want that to happen. I mean, I'm sure the central bankers would be extremely happy if a lot of regional banks just went out of business just from the panic of this. And maybe we have, maybe the media might take the advice from their sponsors and try and create or nurture that sort of panic. I mean, is that out of the realm of possibility? So, but yeah, there's a lot of dooming out there. The entire bank system's at risk. Maybe they're working for the central bankers and the big commercial banks too. Okay. Maybe they have a relationship. Even these guys you don't see a lot of, maybe they have a relationship with some large banks, and they're going to doom about it and help create a panic. And they know that the only thing it's going to hurt is the small banks, and the big banks, they won't even need any help. They'll create this panic. So that's a tinfoil hat, boiler mechanics, tinfoil hat, whatever. So that's where I'm at with it. But it looks like a special situation. It looks like a particularly corrupt bank. And I would encourage everybody to go to small banks over large banks. You have more control, more oversight, really. If you don't have oversight over a bank, big or small, you shouldn't have your money in it. There's the argument that, J.P. Morgan, they'll always get, that's my argument. J.P. Morgan, if there's a problem, will get bailed out. But that doesn't mean that small depositors like myself would be protected in such a case. So anyway, I am out.